Let's get this. Good evening, everybody. Yes, I see you guys are waiting for the code, and right there, it's the code is right there. So, and it's also displayed on the screen. So now, this is an exciting session. My name is Mathendu. I'm joined today with two panelists. And that is Victor Arimi, and Rachel Kawanyoro, who will introduce themselves, and we can now proceed with the session. And today we talk about derivatives. What are Binance derivatives? What are some of these things that you could actually be doing, in terms of the derivative programs? I see you guys have gone to redeem the code. All right. Victor, please go ahead and introduce yourself.
Hello guys, my name is Victor. I'll be taking you through most of the session today on the derivatives. We'll be looking at options trading, we'll be looking at futures trading. We'll also be looking at other things that come with the derivative side of Binance that are offered in Binance. So looking forward to a good session. Thank you.
Thank you so much. That's Victor. Victor will be our speaker for today. And just as an addition, we have, Rachel with us, with our Binance Angel. Please, Rachel, go ahead and introduce yourself.
Thank you, Mathendu. Hey, everyone. Thank you all for joining us today. And my name is Rachel Caballero, and I will be answering some of your questions on YouTube and Facebook as well. Hope you enjoy the session and please learn something.
Thank you. Thank you so much, Rachel. Guys, remind your friends to join into the session. Let them come and learn Binance the right way. Let them, be taught and understand this particular topic very well instead of just going without knowledge. So previously, we've covered Binance spot trading. We've also covered a few other topics like, we've covered spot trading, we've covered Binance Earn. So just notice that Binance spot trading will be part of the prerequisite for this particular webinar. Why? Because we will also be showing a bit of how to do the order types. In fact, that's the one thing we'd like to get guys to just a recap of how do you do spot trading? What is spot trading in the first place? So Victor, maybe you can share your screen, show us a bit of what spot trading is, and then we can go to the next session, so that we can now be able to understand futures trading and what the derivatives are all about. At the end of this session, we still have more giveaways to go. All right. So keep in touch. Listen carefully, because giveaways will only go to the people who are listening carefully and are able to ask and answer the questions as well as possible. All right. So now, Victor, let's kick off the session with a bit of spot trading and understand what spot trading is.
All right. So a moment, let me share the screen with you.
All right. As Victor is sharing the screen, I'll talk about, no, sorry, the screen is right here, so we can proceed with spot trading.
Okay, so as you can see, this is the Binance spot trading page. So we covered things like how to get into positions. That is where with the setup, you come here, and how to buy, that is go long, go short. Yeah, we don't go short on spot, because that is the point with spot, is that you own the stock you own the crypto that you're trying to trade. So in spot, you buy the actual crypto, you hold it in your wallet, and when the price is right, you set your sell order, so that you can sell the coin that you have. So that's the basics of spot. Now, as you see later in futures, you do not actually you do not get to own the crypto asset. You own a contract that is a derivative that gives you the right to access the price. That is a derivative of the price of the crypto that you are holding. So you get to be able to short without owning anything. That is the selling without owning, which is called short selling, and and buying actually, and buying so that you can benefit on price increases. So that's basically the difference that we'll be looking at today. So in the spot trading, we also covered types of orders that you can get to, which are here, which are carried here. You can see them here, like the limit orders, the market order, the stop limits, the trailing stop limits, and all that. We also showed you how to move money from the wallet to the spot wallet. So in this, today we'll be moving the money to the various wallets, which include the futures wallet, that is the CoinM wallet, and the others. So today that is what we have. So, and then on the trading fees, you can see some coins also have better trading fees. Today you can see the BTCPI is free on the spot trading. You look at what the fees are like in the futures, in the derivatives side. Munene, you have something to add?
Not really, just a very easy way of understanding what spot trading is, which basically involves the directly purchasing or selling, not necessarily just crypto, but any financial instruments and assets. This could be, forex, stocks and bonds, and of course cryptocurrencies. And the delivery of the assets is often immediate. All right. When we say spot trading, it occurs in spot markets, which are either exchange based, or they can be OTC, what we call over the counter trades, which is what happens between traders. All right. So that's the main thing about spot trading. Basically, the main difference is whenever you're trading on spot, you actually buy, assuming, let's say you're using Bitcoin to trade on spot, you're buying the actual Bitcoin. But then when it comes to futures, you're buying a contract of the a contract of the underlying asset. That's the main difference. All right. So we'll be seeing that shortly as Victor introduces that particular part of spot trading, or rather futures trading, and more on derivatives. So let me know when you're able to share your screen, Victor. In the meantime, just as a reminder of the order types again, basically I'll go to that particular screen and we can see the order types so that we are able to kind of also see how can you be able to configure these order types and what are really, what are they really about. And then we can now just move to the futures part, because this is something we really need to understand. So one of the things, the limit order basically gives you the flexibility to say, okay, I need to buy a particular asset at a certain price. So that's the limit order. So I can say I want to buy Bitcoin at $21,000. Whenever Bitcoin hits that particular price point, then that's the order will be fulfilled. Then the market order, what it means is buy at the current market price. It doesn't necessarily matter what the price is, just buy at the current market price. That's what the market order means. Then we have the stop limit order, which basically combines a stop price with a limit order. The stop price basically says it's a trigger. In case this price is reached, then the limit order is executed. Remember, the limit order is put in the order book, but then the stop limit order is not put in the order book, all right, until the stop price is actually hit. Now, let's go. What I mean by the stop price, let me demo here a bit. In case I can say if Bitcoin hits 20,300, please put a limit order of 20,500 and buy me one Bitcoin. All right. So what that means is whenever Bitcoin hits $20,300, a limit order will be put into your order book of 20,500. That's what a stop limit order is. Then an OCO helps you kind of capture the range where it's basically a take profit and a stop loss order coupled in together. So it combines the limit order with with an upper range. One cancels the other. What that means is I can say, okay, if I'm holding Bitcoin, let me go on the sell side now and demo with the sell side. If I'm holding Bitcoin, sell at 20,800. However, in case Bitcoin decides to go down and hits a price of 20,300, please put a limit order of 20,000, usually because you want to underquote whenever you're selling so that you are able to execute the order. So put in maybe a limit order of 20,195 and the amount of Bitcoin you'd like to sell. In this case, you can just put in one. So this order means if Bitcoin hits 20,800 and it will basically sell, all right? But in case Bitcoin decides to go low and hits 20,300, okay, let me use realistic figures here. Let me use like $20,000 right now. And then you can say in case Bitcoin now decide to hit 20,000, then put a limit order of 19,990 to sell one Bitcoin. Basically, that's how an OCO order works. Now, Victor, I hope you're prepared. We can now proceed to the next part and show us derivatives. Right, there we go. Please proceed. Hello, Victor, can you hear us? Hello, Victor, can you hear us? Hello.
Okay, okay, guys, we're here. So today we'll be covering the Bitcoin futures, how to trade Bitcoin futures on this session. So you might want to ask, why do people use Bitcoin futures? One major case for the futures is the opportunity for buyers and sellers to lock in future prices. So this is a process that we call hedging. So traditionally they were used as hedging instruments, but nowadays they're mostly used for speculation. Yeah, and because they give you the ability to bet on the state of the market. That is whether you take a long position or a short position. You also get to access the leverage without using all your capital. That is where you get to have a better leverage on the trades that you take. As you can see, you're able to take large leverages with that one up to, you can see, up to 125. But the more the leverage, the greater the risk that you're taking with your position. So
Maybe Victor, can you tell us what leverage means?
leverage is like gives you the ability, is like a loan that you're using somebody else's money to get into a position that is larger than what you have. That is including debt in your capital. Because when you use your capital alone, you'll not be able to get into a larger position than you'd like to get into. Like say you have $100 and you feel that this position I could better do it with $1,000. That is where leverage comes in. You set up your leverage, because it's not like you're applying for, it's basically applying for a loan, but you get to use it on the go. So you use your capital, the capital that you have, use it as your collateral. You see, use it as your collateral so that when the price goes against you, you only get to lose your capital, up to your capital, the maximum of your capital. So if the price goes well for you, you get to gain almost more than your capital. You get to make money at larger options, that is at a larger factor of your capital, that is including debt in your capital. That is what leverage gives you an edge, an extra edge that you get to use to play with a bigger bag. You get to play with the big boys, as they say. Yes. So is that well answered, Monene?
Yes, I think that's well answered. So I think we can proceed now. And by capital, we mean the amount of money you're holding, all right? The amount of principal amount that you're holding.
Yes. So going forward, those are basically why you would need to use Binance futures, that is the futures in general, because they give you multiple possibilities for arbitrage as well as better trading strategies, because you can even own the underlying and trade short on it. You see, hedging basically. So the benefits of trading the futures will be more like that. You're able to hedge. You see, you're able to hedge. In this case, we might even see like back when in mined coins like Bitcoin, you have to see that people have running costs that they rely on for the product. So hedging will get them to be able to gauge the market, to trade while holding, you see, hedging their positions, that is. Anyway, so in the spot market, you'll find things like you're not able to hold both on the sides, but in this side you'll be able to hold to you'll be able to hold a contract against your position, that is against your assets. So you're basically trading at zero value. We understand each other. You have no position. You literally don't have a position in the market. Or maybe let's say you're trading a position, you are long, you have bought let's say Bitcoin, and you feel that the price is now after a few days of gaining, you feel that the price might now go down a little bit, and you don't want to sell because of the trading fees involved in the spot market. So you feel like I don't really want to sell because I'm holding it, and I've already committed my money in something like staking pools or all that. You don't want to sell your crypto, but you know very well that at this point, after doing a technical analysis, you might feel like this price is already too high. It might adjust a little bit before we continue with the rise. So that's why you come in with maybe a short position on that, on a contract of the asset you own. So you take a short position, you benefit on the long term, on the short term price change. Then when that one is done, you continue with on your way. So if you're wrong, maybe you lose something a little. If you are right, you continue holding your coin and you get something else on the side. That's what it means to hedge your position.
So maybe Victor, can you talk to us about you've said something in the line of if you are wrong, you will lose something, if you are right, you gain something. How can you use an OCO order to kind of um reduce your risk by putting particular margins in case prices reach, let's say, at exact points? Okay, now cut my losses. In case prices reach at a certain price, then okay, now take your profits that way. How can we be able to do that with using an OCO order?
Uh, as it's called, the OCO order is one cancels the other. So basically means one cancels the other order. So with the position, maybe let's say you have you have your order. On the order, you feel like what do you call it? I'm missing the words for this one. Munana, maybe try taking that one as I look for the words for that one.
Sorry?
Maybe you can say something about it before I find my words to describe the situation where you would need to close the
All
position.
right. So for OCO orders, one of the things they help you very well with is in futures you're actually using leverage. You are actually using borrowed money, and you're giving your capital as the collateral, but then it cannot be moved off the futures account, right? While the trade is on, all right? Now, one of the things you'll notice is if say the price of Bitcoin has moved by, let's say, 4%, and you are on like a 3x leverage, rather 3x margin, then it means you are very high likely to have about a return of 12% on your capital. But then that the opposite could be true. All right, in case, let's say, the price of the asset you're trading decided now goes against what you've had been speculating, then you stand a chance to kind of lose up to 12% in that case. Now, how can you be able to kind of lock in your profits um while trying to kind of minimize your losses? That's where an OCO order comes in. And you say, okay, if the price gains, maybe you are targeting with a strategy of let's say 2% to gain that day, and you're on your 3x margin. So if the price goes by 2% and you calculate the rate at which by the time of entry you're getting into the trade at the time of entry, then that means you can say when the price hits X amount, then take profits. And of course, an OCO order cancels the other. So it will cancel the stop loss you had put, which is a stop limit order. All right, because OCO orders are coupled together. Victor, maybe show us, take us to the screen for OCO, and then we can be able to configure one of the orders right there. Are we in the testnet? Victor, can you hear us?
Okay. Stop. The testnet today is not logging in correctly. I'm not able to access my account of testnet. So.
All right. I get it. So I think it's clear though. So I think we can still proceed and tell us maybe the main difference between coin margined futures and USD-M futures, USD margined futures.
Yes. So on Binance, the futures options, you get to have two options. One of them is a coin margined, and the other is a USD margined. So with the USD margined, that is what you are borrowing. That is what the contract is based on. That is the margin part. The difference, the main difference actually is the coin that you are using as your collateral. So for the coin M futures, you find that you are using the crypto as your margin. That is as the collateral for the trade. And with the USD-M futures, you'll find that you're using either BUSD or you either find that you're using the BUSD or the USDT as your margin. That is why it's called the coin margined future. And the other one is called the USD margined future. That is the basic difference. That is, both contracts are available on either perpetual futures, but some of them you either find them that they are the ones with expiry. They also get to have an expiry. So yes. So we can go to the system and I can show you the difference, where to find them.
All right, please show us how to get to the features option, tab on Binance, and maybe I can show you as you show the other testnet. So for those of us interested in trading, when you log in into your Binance web interface, features is under derivatives, and under derivatives you'll find USD-M. USD-M, as explained, is basically futures contract which you trade dollar-backed contracts that could be stable coins. USDT or USD. Then for USD-M, you're basically the contracts are basically settled in cryptocurrencies, the underlying crypto you're actually trading. So maybe Victor, can you tell us what's the main difference between what does it mean perpetual or quarterly contracts? What does it mean? What's the difference?
So you'll find that the Binance gives us two types under each type of futures offering. So you'll find that you're getting the perpetual derivative, the perpetual ones, yeah, and you also be getting the ones where you the quarterly, the ones with the quarterly delivery. That means the difference means that with the perpetual, it never expires. That is, it never requires it never requires rolling over. But with the quarterly one, you'll find that after every quarter, that contract must be delivered. Do you understand me there? So
All
it
right,
must
all right.
be delivered after every quarter. But with the perpetual ones, it just continues. It's more or less that is, it does not have an delivery time, a time where, a duration where it will be required to be. So you can trade the perpetual futures the same way you trade. You can hold it perpetually. That is, as the same way you hold your asset, the actual crypto asset. That's how you find yourself. That is where you find the future. But with the quarterly one, every quarter there must be a settlement of the orders, and that is your position will have to either be rolled over or close. And by rolling over means that you close the contract that is expiring and open another one in the next quarter. The next one, that is, you roll over your position, you close and open again. That is the rolling over the position. Okay.
Thank you for that. So I believe you're using the testnet, so you can proceed and show us a bit of how to, set your take profits, stop losses, etc. Please proceed.
Okay. So today we will not be on the testnet because testnet is having issues on logging in at this point. I don't know if it has recovered. So we'll basically use the actual system as it is. So let's say you take a position. This is the coin. This is the this is a USD margin one. So no, a moment, sorry. Let's get into the system. Yes, now we are in. So you find that, let's say you want to get into a position at a long position, you come here, select the price that you want to, or type it manually. You can select it on the order book, or type it manually, whichever way it works. Whichever way you feel comfortable, that's how you do it. So first, your wallet must have the security. Must have the security that you're looking for. That is, the margin must be in the wallet. Whichever wallet you decide to, you can either set it as cross or isolated. Those are your decisions that you have to make as part of your risk management, as part of your trading strategy. Because you don't just get into a position without identifying a strategy. You need to work out a strategy before even coming to look at how to set up the prices of such a situation. So now, let's go with the limit order first. So you come here and you key in your price, the price that you want to. As I've said, you can either do it here or here, whichever side, that's up to you. That's part of your strategy. Then you decide the size of your contract. So you can see, because we don't have anything here, you can either slide this one to get a portion of the amount that is in your, what you call it, of the amount that is in your wallet that is available for the trade. So we come here, we said, let's say we want to take a position of two Bitcoin, then you'll be given the cost. As you can see, you get the cost here of your position. Let's say we adjust the margin to something like 50. Ask you to confirm, because margins. That's how you set the leverage. That's how you set the leverage. So you come here, you set, let's say, 2 Bitcoin. You can see at 2 Bitcoin, your cost is at $847. That is what you're getting. When you decide to short, you get the cost at 838. When you decide to go long, you get the cost at 802. That's because the price is still moving. Anyway, so we come there. Then you can decide to either do this is where you decide to enter the position. With the long, will not be entering position because you don't have capital in the wallet. You can see it telling us insufficient margin. That's why we said that you should have funds in the account first. That's how it works. Then you can decide to also sell short. Selling short, you can either come here and select to sell short, or even set a target here. You can also as well. You can look at the chart and decide you want to do that. You can as well use the small one here, the pop-up. This one, you can drag it to anywhere you wish and enter your position. And this one also give you a limit position entry. So you can either, the next option you have is doing the market order. A market order does not give you the ability to set the price because it takes, this is a taker. You'll find that in the fees, if you look at your order history, you'll find that there are positions that show you that you are either a market maker or a market taker. When you use market orders, you are a market taker. And the fees, you can see in the fees page, when you visit the fees page, you see that there are different prices in the fees for takers and makers. So when you take a market order, that's a taker. And when you can also take a market order by, there are many ways of taking a market order. You can either click above, you can either place your limit order above the trading, above the market. So if let's say the market is trading at 20,022 and 4 as at now, and then you place your order, your buy order at let's say 20,100. You see, it will be executed immediately. That is also equal to a market order because you're not setting a limit for it. You're using a limit, but you're taking the price that is in the market. So you will be classified as a taker, not a maker. Now, with the limit orders, when you set it below the market for a long order and above the market for a short order, you'll find that you are a market maker because you're making the market for anybody who comes there, and that is why most exchanges will give you better prices for making the market. So with a market order, we come and we set the size. We tell it, let's say, to Bitcoin, and then you just either take your long position or a short position. You can see you'll be given your cost. You'll be given your cost here. Now, for a coin M, the cost will be in terms of the coin. That is, if we are doing this order under coin coin margined futures contract, you find that your cost here, where I'm highlighting, is everybody able to see that, Monene?
Yes,
Lorena?
we are able to see this.
Okay, so you'll find that your cost will be in terms of the coin that you're trading, and in this case that would be in BTC. But because you're using the coin margined, because you're using the USD margined, our cost is in USDT. You can see the difference now. The difference is coming out quite clear. So that's how to set it. You can also come here and change the kind of margin you wish to use. So with a cross margin, you'll find it just the same as it is with the leverage, with using leverage. You'll find that you get either a cross margin or an isolated margin, telling you that if you decide to use an isolated margin, the collateral that you give can only be used on that contract. That is, in this case, the contract is the BTC USDT perpetual contract. So you find that your collateral is only useful for that price. Whether it gains, whether it goes down, does not affect that. So you find that this gives you the ability to manage your risk better. Because if things are not going, if you use a cross margin and things say you're trading the BNB USDT perpetual contract and also the BTC USDT perpetual contract, you find that when the BNB goes wrong, it also affects the liquidation price of your BTC contract. That is their position in the BTC. But if if you use the isolated one, you find that whether it does not matter how many other contracts you have there, they may get liquidated, but your one contract that is not doing bad will remain unliquidated in the event that things go wrong. That is because you're not able to predict the market. What you can only do is do your analysis and then trust in yourself and monitor your position. That is, you have to monitor your position so that if things go wrong, you can use the stop limit now. That's why you come to the stop limit. The stop limit gives you the ability to close your position. Whether you're there or not, you set first, as it is said in risk management, we are told to not risk more than 1% for some people, 2% for other people of your wallet. That is of your capital that you intend to use in that position. So say we intend to use, say in the case that we intend to use $1,000 for the trade, for this trade, that means our capital is $1,000. So 2% of that would be around $20. Is that correct? Yes, that would be around $20. So in entering that, you have to set your stop loss such that you do not lose more than that 2%. That is, you set it so that you do not lose more than $20. And you can even, Binance has the other option of using a trailing stop.
Victor, just before we go to the trailing spot and showing, I've seen a bit of, a concern about some of the terms. I believe, some of us may have come into the webinar not understanding that it's a bit of an advanced one. However, we are here to teach you now. So I will cover a few of the terms that we need to understand. What does short selling mean? Basically, remember that you can make money when the price of an asset goes up. However, you can also make money when the price of an asset is going down. So in a process which we call shorting or short selling. So it basically means selling an asset in the hopes of rebuying it later at a lower price. So basically a trader can enter into a short position expecting the asset's price to decrease, meaning that they are kind of bearish on their assets, all right? So instead of just holding and waiting, so some traders, may decide to adopt the short selling strategy as a way of, profiting off an asset's price. This is why short selling can also be a good way to preserve capital during price declines. It's very important to know how to do short sales during bear markets, like right now, because you're expecting the price to be hitting a certain range, and you can actually be trading long and short positions. So long positions is basically speculating an asset's price will go up. All right. Short positions, it's basically speculating that an asset's price will go down. Now, what Binance gives you in terms of how are they unique? First of all, there's a lot of trading volume on Binance. On Binance, any product, futures, may it be spot, there's a lot of trading volume. There's also a lot of opportunity for you to be, to get leverage, all right? So you can use a margin account. You can open the margin account, which will allow you to have increased buying power. So then you can use the leverage to trade bigger positions than your actual amount of cash that you have in your account. What I mean is, let's say you have $100 and you'd like to trade on a 10x margin. 10x margin basically means you want to trade 10 times your initial capital. So basically what will be happening is the platform will be lending you, as Victor is showing you right now. You can go to 10x. So now you will be trading with up to 10 times the borrowed 10 times the amount of capital you have. However, remember, these markets are volatile. All right, these markets are volatile, and price changes could be going down, could be going up. And in case you're, let's say, on a short position and the price goes against you, like prices decide to pump, and you're on a 10x margin, 10x leverage, sorry, then that means when the loan to value reaches around 65%, loan to value basically means whenever I'm borrowing, I have $100 and the platform is lending me 10 times, that is $1,000. In case the loan to value, the amount of money I'm being lent to the amount of capital I'm providing as collateral reaches a certain percentage. Usually I believe it's Victor, please confirm, is it 65 or 85%?
83.
83%. So what that means is, in case the position goes against you and hits 83%, then you get a margin call notification. You're told, okay, now either you top up your capital or we liquidate the position is actually liquidated, right? So you get the notifications prior to that liquidation. Now, what does that tell you? Margin and leveraged products can be very beneficial to you. Why? You see, if you're looking in, let's say, a 30x and you're just getting 0.5%, then it's very easy for you to be making up to 15% in terms of your initial capital. The problem is, if you don't have proper risk management skills, where some people will come in with small with like $30 and you're trying to go on a 125x position, that's overly it's a bit outrageous to start with, but then it's also overly risky. What that means is, you have $30. Okay, let me use $100 for the math to be easier. You have $100. You are trading on a 125x leverage. That means you're trading with 125 times 100. That's 12,500. By any chance, if the price moves by 0.01%, your liquidation point your margin call position may reach very quickly. And you'll find that some of the people trying to trade with these overly large leverages will often be losing a lot of money because they are just overly leveraged. Sometimes you won't even enter the market. The price has already moved before you can try to make some bit of it. All right. Then in terms of the technical terms that you may need to know, the TP/SL basically means take profit and stop loss positions. And then Victor can explain to us what reduce only means and what reduce only means.
So a reduce only option is one of the options that you get. So it just serves to reduce your position. Let's say you have, in this case, you have a position of $1,000 with a leverage that means 10 at the leverage that you're using anyway. So, so what that will do, if you have this position and you enter a short position, let's say that one was a long position, and you enter a short position, whichever short position you enter will only serve to reduce the long position you have. So let's say you enter will not increase your position, but will only serve to reduce your position. Do you understand each other? Will only serve to reduce your position. You can as well disable this so that you can have orders on both sides. That is, you have a short position while you have a long position moving on. There are people who like to see all their trades working. Like say you have a long position, a long-term long position. So if you have a long-term long position that you have looked at, you're using the weekly let's say the monthly, you're trading on the monthly, but now today you're feeling that I know there is some fundamental news coming out, so you are ready. You know that there will be some volatility in the market, so you want to capitalize on the volatility. That means that you enter a short-term position, not a short position, but a position that you are trading in the short term. Remember, you have a long-term position. These positions, the short-term position might be in the opposite direction. You might decide, well, in the short term, if I look at my chart, in the short term, I feel like on the daily chart, I can see that the prices are too high, so I decide to short in the daily chart. But in the long-term chart, I can see that the prices are still too low. So you feel like in a month or so, trading in the month or so, you feel like the price will be going up in the long term. So you have a long position that is actually in the money, but you don't want to close your position while trading. Before you don't want to close the position, you still want to hold it. But now you feel that there's some volatility coming in, the price might adjust, might retrace a little bit. So you get your short position and set this. That is why you don't you remove the reduce only. So you have positions on the opposite side that do not reduce your position. But in that same event, if you set this ticker, or if you selected here, the position would reduce the long-term position. You are trading the short term, but you have actually reduced your long-term position. Am I clear there?
Right, right. I believe I also got something I didn't know there, and maybe a bit of an explanation. We are about to do the second giveaway right now. So, Victor, prepare a question, and type it on the chat box as I continue speaking, and then the very first people to get the answers right will stand a chance to win a minimum of $10. A minimum of $10. All right, all right. I see Kadambi Mirero says the recording will always be shared. That's correct. The recording will always be here so that you can be able to come in and, review this particular session again. All right, just before we proceed, Victor covered two things that I think some of us didn't understand. That is the isolated margin account and the cross margin account. All right. So a bit of an explanation of what these particular margin accounts mean. First of all, what is a margin account? So a margin account, allows you to have increased buying power in terms of you can, whenever you are trading, when you're on spot, you can only spend the amount of money you have, all right? But when you move it to the margin account, you can spend up to how much the platform is able to lend you, all right? You can spend up to how much the platform is able to lend you. So that's what we mean by a margin account. That's the difference between spot and margin, the main difference between spot and margin. Now, when it comes to margin, we have two types of margin accounts on Binance. So one is called the isolated margin mode, and the second one is called the the cross margin mode. So let's see the difference. Let's see the main difference. So first of all, for margin in isolated mode is independent of each trading pair. When I say a trading pair, what I mean is you can be trading Bitcoin against USDT. You can be trading Bitcoin against BNB. You can be trading Bitcoin against BUSD, these stable coins for coin margined accounts. All right. First, I remember we said there's USD-M, that is USD margined accounts, which settle in stable coins. That would be something like BTC USDT, which are mostly in stable coins. All right. Now we have coin margins, which could be a trading pair, like could be anything like Bitcoin BNB, Bitcoin against Ethereum against ADA, could be anything. All right. Now you've decided to trade for whatever reason, maybe BTC against Ethereum. Victor, maybe you can switch to that trading pair. So now, a trading pair,
what pair?
Ethereum, BTC against Ethereum, BTC ETH. So remember the ticker symbols that we taught you. BTC ETH is basically means BTC, the ticker symbol for Bitcoin, and then ETH, the ticker symbol for Ethereum. Now, all right. Now let's go to the next part where, okay, I'd need to have it as a coin margined account, a coin margined features, right? All right. Now, what does margin in isolated mode mean? It's basically each pair that you are trading. You know, you could be having different positions open. Let's say you are in a position on, you know, you're in a long position for Bitcoin against Ethereum. You're in a short position for, you know, Ethereum against BUSD, all right, on those particular trading pairs. So margin in isolated mode, margin mode is independent for each particular pair. So each trading pair has an independent isolated account, all right? So only specific cryptocurrencies can be transferred in that particular account. Think of it as you have an account within another account, all right? So only specific cryptocurrencies can actually be transferred in, held, or borrowed in that specific margin account, all right? For instance, in, let's say, BTC USDT isolated margin account, only Bitcoin, BTC, and USDT are accessible in that particular margin account. So you may open several isolated margin accounts for different trading pairs, all right? So the position is kind of independent for each particular trading pair. If maybe adding margin is required, adding that particular, let's say you're almost hitting your liquidation point and you need to add you know, more capital for you to kind of increase your collateral. If adding more margin is required, even if you have enough assets in other isolated margin accounts or in other cross margin accounts, then the margin will not be added automatically. You have to replenish manually, all right? You have to add that manually, all right? So the margin level is calculated solely, all right? It's calculated solely in each isolated margin account based on the particular asset and the particular debt that is in the isolated account. Now, the risk is associated in each isolated margin account. Once liquidation happens, it cannot affect any other isolated positions, all right? So I think I'll drop in a Binance, Victor, maybe you can drop in a Binance Academy link describing more about what isolated margin account margin means, so that people are also able to kind of go and read more. Now, what is cross margin? So margin in cross margin mode is shared among the user's margin account. So you have one account, then as long as you top up a certain amount of capital, then that capital, quote unquote, collateral can be used across all your open positions, all right? So each user can only open one particular cross margin account, and all the trading pairs are available in that particular account. So assets which are in cross margin accounts are shared by all positions. So you have an Ethereum position open against USDT. You have a Bitcoin position open against BNB. You have a ABA position open against maybe Aave. All those particular accounts, all you have to do is top up one particular collateral, and it covers the margin for all these particular open positions. That is what cross margin means, all right? So if you have any questions, please ask them now. So far, I know this can be a bit overwhelming. It also took me some time to also understand some of these concepts. However, the moment you do understand, you actually do understand by trying them out. Don't just read and try them out. So Victor, please prepare your question so that we can also be be able to reward some guys here who have been following the session very well. Do you have any
The
questions?
question has been shared. Kindly check the chat.
All right, on it. So Rachel has shared the Binance Academy isolated margin article. Please read it. Rachel, please also pin it on the Telegram group so that everyone can be able to benefit from this. Also pin the cross accounts, and so that you can be able to understand that. So I think, Victor, we can conclude on the futures part so that we can move on the next leveraged products. So let me know what would you like to kind of cover more, and then we can proceed to the next product.
Yes, I trust we've covered almost everything that there is to know about, other than the stop loss, which is the same as what we do in the same as what we do in the spot trading. For those who attended the stop trading, which was a prerequisite for this class. So you can see here you have the stop loss has 3 features. So you get to set the stop price. This is the price at which this order will be triggered. Yeah. So you can either decide whether it's a mark, that is the one that the Binance gives you, or the last traded price. So here you find that this is where I'm highlighting. You find that this is the mark price and this is the last traded price. So you can either set your stop loss to trigger on either the mark price or the last traded price. So that's where you get to set it here on this drop down. So the next thing is the price. That is the price that you want to place the order at, and this one is the size. You can set the size as a percentage of your position. That is by sliding this. So that's basically how you set a stop loss. So when the trigger price is reached, you find that whether you decided this is the last price or the mark price, that is where you find that your stop loss will be triggered. So your stop loss will be triggered as a limit order, taking into the fact that you want to stop your losses from happening. So then we also have the other type of a stop loss. You can also have a stop market order, which means that one will just, once your trigger price is hit, the stop price, then the market will just sell at any available price. That is, you just take any price. Yes, I want to get out and I want to get out right now. That is what that means. So you can either set it to trigger as well. You can either set it to trigger at the mark price, which is this price here, or at the last traded price, which is the last traded price on the trade. You can see these ones here, which are here. This is the order book. These are last trades. So then there's a trailing stop. A trailing stop is a very nice feature that will allow you to continue on your position. So let's say you have entered a position at say you got in at 1300. This is the ETH. This is the Ethereum contract, the Ethereum 2.0 contract, futures, Perpetual. So let's say you entered it at 1100 or 1200. Let's say 1200. You entered it at 1200. We are now at 1350. So what would happen at the 1200 entry price? That is, you would have to set your price, your stop loss, to control the risk of you losing your capital. That is, we say that mostly you should avoid losing more than 2% of your capital. So that's why you get to set your stop loss. But now your position is making money. You see, your position is making money, but you do not know whether the trend. And when you look at your technicals, the momentum has not changed. The trend is still holding. So you decide, well, I'm not getting out of this position, but I feel like the prices are too high. Your technicals can tell you that the price is too high. Maybe like an RSI of around 80, 90. You see an RSI of 90, that means you're already past the oversold region, but you still feel that the momentum is not done. So that is where the trading stop kicks in. You come here and give it a callback rate. The callback rate is the rate at which, let's say you want it, the rate at which it will trail. So you set it, let's say you take it at 1%. So what this means is that when the price changes, that is the last maximum price changes negatively. So if you have set a sell position of a trailing stop, if the last price goes up, that is, we are here at 2,000, the price is now at 2,100, and you have a 1% on that one. So 1% of 2,100, that would be around 21. I believe that would be $21. So when the price moves against the sell position, against your long position, that a sell short, that would be closing a long position, and a buy would be closing, a buy trading stop would be closing a short order. So in this case, you entered at 2,000, you are now at 2,400 or 2,100, and you want to lock in your profits, but you don't want to get out of the position. So you can set this at 1%. So when the price changes, say it's now 2,200, has gone to 2,200, your stop loss has been tracking that position by 1%. So if the price changes by 1%, that is $22. If it goes down by $22, your stop price will be triggered. Do you get? So you are at 2,100. You found the market was oversold, was overbought, and you felt that maybe it might continue. So you don't get out, and now you're at 2,200, and you set a trailing stop. So that one follows your position. So that at that certain point, given your callback rate, the position will close itself automatically. So you also set an activation price. That is a price where this is a trigger condition. That is the price where the order will be hit at. Do you understand me at that point? So you set it's normally the same as a trading position, only that it has a callback rate, which allows you to track the market. So as the prices go in favor of your position, it does not close. But when it goes negative against your position, automatically the position is closed. You see, you get to risk more without risking anything. That is, you get to gain more without risking that is while locking in your profit. That's a trading. So next, we'll
Yeah, I think we've actually exhaustively covered futures. I'd like us to now proceed to the next leveraged products. Let's explore a bit of what options trading is, and Victor, can I first of all, I see the questions. We are being asked for the questions. I can't see the question as well. Would you mind reading it or just typing it again? The question so that we can ask. Oh, I've seen it. So sorry. Now the question is uh, differentiate between delivery contracts and perpetual contracts. Differentiate between delivery contracts and perpetual contracts. Those of us who've been listening, put your answers right there. We'll select the correct answers and send you some gift cards that you can actually redeem instantly. All right, now, Washema, I see you say you're back. The question is right there. Don't miss out. Don't miss out. Victor, help us find the first answer that you're looking for. Help us find the first answer that you're looking for. I see guys moving towards, to search on Google. No. I see. All right. So Victor, in the meantime, you can be explaining options trading.
Okay, so the options trading, Binance gives us the option. Let's basically go to what an option is. An option is a contract that gives you the ability to either sell or buy at the current market price or a better price that you decide in the future. That is, you get to decide now that I want to buy at a certain price in the future. So you get to lock in that price now in the future. That is basically what the option is. It's just the option to buy or sell later at an agreed price today, given a certain set of conditions, that is. So these conditions basically will be based on these conditions are the one that gives the specifications of the options contract. These will be the strike price, the exercise, and so you'll find that okay, so these are the ones that gives them. You'll find that there is a strike price and the actual price that we're doing. So you'll find that Binance gives you options that only that is Binance gives us the European options type. As you can see here, you are welcomed with something so that you can get to agree to the terms of on Binance. So let's go through it and see what they say. So you are told that these are the European options that can be exercised only at the expiration date. You see, you can buy it, you can sell it, but you can only exercise it at expiration. So the only price that the strike will be taken into account, the strike that will be taken into account will be the price at expiration. With the American options, you can exercise it at any given time. That is what the difference is. So these ones are only European options. So these are so we have to open an options account here. So they're basically So we have two types of options available. You have the call and the put. The call gives you the option to buy at a later date, and the put gives you the option to sell. So you can actually hedge your position. You can actually hedge your position with buying the actual crypto, and then also buying the options. That is what they are used for. They are mainly used for hedging. But just like everything else in the finance world, you can also use it for speculation purposes. So before you continue, let's see if the question has been answered, the question that was asked. So for the giveaway. So Monene, have you found anyone?
So let's see the answers that came in. Let's see the answers that came in. The first answer which came in, I believe, was Otis Elvin. Let me know. Team Elvis says perpetual contract never expires and quarterly expires after every quarter. What do you think of that answer, Victor?
Yes, it's more of delivery, that it never gets to be delivered, and yes, so it never expires. You can basically say it never expires, but that would not be wrong to say that. So
All
over to you.
right, right. So I think that's our first winner. The second one was I think Usman said the same thing. Usman will be the second winner. And Usman and Team Elvis, please DM me on Telegram. That is Madendu_KE. DM me on Telegram to claim your gift cards. DM me on Telegram. Be sure to be on the Binance East Africa Telegram group for you to be eligible for that. So I believe let's find some users on Facebook who answered. I think Anthony, no, Israel Anthony will be our Facebook winner. We'll also send you a gift card shortly. Israel Anthony will be also sending you a gift card shortly. And then the second Facebook winner is Adam AB. Now, these two Facebook winners will reach out, but be sure to be on the Binance East Africa Telegram group before the webinar ends. Remember, we still have more giveaways for you guys. So stick around as we proceed with the session. Stick around and we'll be able to, reward you more. Stick around during the session and we'll be able to reward you more. So now, Victor, I believe what the next part we are supposed to cover is basically show us what is margin trading and, a bit of an overview, since it's part of the derivatives, and show us what is, first of all, just before we go to, okay, show us margin and then we can show what strategy trading is and kind of how to manage your risks, whenever it comes to trading.
Here we are. So margin trading, as you mentioned, the margin during the futures is no different. It's no different from the margin that we looked at in the futures. So you either have a cross or an isolated margin. So you can either decide to trade with a cross margin or isolated margin. Only that here you get more finer control on the leverage that you're using. You actually get to own the underlying. So you're actually borrowing. You get to hold the underlying that is the coin that you're trading. So if you decide to trade the BTC pair, this is the BTC pair. Yes, if you decide to trade the BTC pair, you'll find that in trading leverage, we will actually get to own more of it. So you can decide to buy two, and you'll be told that the amount you need to buy, you do not have the amount. That's why you're throwing all the red lights. But you actually get to own this the underlying, because this is spot trading. Margin is in the spot trading category, so you get to own the coin that you have. This one increases all the things that you want to do with the coin. So you get to own that coin. You get to own it at more. Is quite different from the loan, because you not the difference between this one and getting the crypto loan is that the crypto loan gives you a percentage of the total capital you have. A percentage of the capital in the particular collateral you gives you a percentage of that. But this one gives you multiples of it, which you can use across. So let's say you have $1,000, you can use it to trade as a cross margin to hold BTC of $1,000 value. Still hold the BNB of $1,000 value with a 3x cross margin, and still hold another crypto at $1,000 with the $1,000. So in trading these, what you get to adjust is there are also things that you get. There's the auto pay, and you can also set it to how to pay is the other thing that you get to control with this one, because it's a loan. At the end of the day, it's a loan that needs to be paid with interest. So you find that you can go to the borrow and get the rates. You can then decide to repay. You can even position it to repay automatically as it gains. Your position, let's say you have borrowed 1,000 to trade with, and now your position is total value given, even including the leverage, is at 2,000. You can decide that with the profit that is coming in, let's be repaying the loan. Instead of holding profit in the account, let's use the profit that is coming in to repay the loan. So that's the beauty about trading, margin trading. So with this one, you also get to transfer the collateral to the margin account. That's why you get to transfer the collateral. You don't transfer it to the futures. You don't keep it in spot. You transfer it to the margin wallet. So you have all your types of wallets there. So you transfer it to this one here, the margin wallet. With the futures, you are transferring to the future wallet. So yeah, that's basically what margin trading is. Now you can go to the managing your risk and wisely trading properly. Monene, do you have something to add on that one?
So basically, I don't have so much to add on margin trading. What I'll remind you is when you're using margin trading rather on Binance, you're actually trading the actual underlying assets. All right. In futures, you're trading the contract. In margin, you're trading the underlying asset, the actual asset. All right. So that's the only thing maybe I can add there. And in margin, you'll find that you have a way to you can auto repay, you can whenever you're you know you have the amounts locked in, you can auto repay as well. So maybe show us how to what auto repay looks like whenever you borrow a loan, and what's the difference between the 3x cross margin and 10x isolated. And remember, margin basically you're kind of doing spot trading, except that you're being lent out money to buy the actual underlying assets. So something else is show us the indicators for risks, show us the indicators right there, and what does transfer borrow mean, such things. Yeah.
All right, let's explore the setup. So with the cross margin, we are looking at the cross. As we said, the cross margin will give you a maximum given the coin. Every coin has a type of margin maximum. So you are told if you use this one with a cross, this coin with a cross margin, you get a lesser rate. That is, you get to have less leverage. You not get more than that. So that's why you have 3x. That is the maximum leverage you can hold on that position. So with the 10x, with the isolated, then you can see that you can see that this one is already at that rate. You see that you're getting a 10x, you're getting more because you have more control over the risk that you're exposing yourself. Remember, as I said, in the cross, with $1,000, you can trade $3,000 across $1,000 for each of three cryptos. That is, given that if that is what you wish to do with your capital, that is the position you're feeling comfortable with. That is what you can do. That gives you the ability to do that, or six positions, or six contracts across six pairs. So that is what you get to do with that, with the 3x. That's the power of the 3x across. But with the isolated, you can only trade in the that is in the contract that you are holding isolated for that contract. So whatever you do, you transfer it. This is where you transfer. Transferring this one gives you the ability to transfer into that. So when you do transfer, you'll be asked to transfer from wherever you have capital to wherever you have capital. You'll be given the option to transfer from whichever wallet you have to isolated. You can see the isolated margin gives you a trading pair. That is, the isolated wallet as a specific. You are taking it to which pair? That is a question that you are asked. This is what this means. But if I have a cross margin, you can see the cross margin does not care where I'm taking it. Does not care which pair I'm going to trade with. But with the isolated margin, if I select the isolated margin, I get to be asked, where are you taking? Which pair do you intend to trade, so that we can know the setup that you get. So where can we deposit this? So now we get to have a maximum. The coin that you're transferring, you select. Because you have the two pairs, you can transfer whichever of the two pairs. You see, you can either transfer, because you're trading the Bitcoin USDT pair, you either you can use the collateral as either Bitcoin or the USDT. So that's why you're getting these two. You're getting the pair here, but you ask which collateral do you have. So if you have the Tether coin, that is what you use. And if you have the BTC coin, that is what you get to use as your collateral. But either way, you have the same position. Then you can decide now to use the borrow. Let's look at what the borrow gives us. So now in the isolated account, you get to see the interest rates that you get. This one is why you're borrowing before you get into the position. You can automatically borrow as you enter the position, as you key in the position details, or you can set up here, or you can wait for it here. You can do this here. So you can do it here. So you're given the interest that you're getting, you're given the amount that you're borrowing. So you even ask the pair that you're using. So is everybody able to see my page?
Yes, Victor, I think I'm able to see the screen. It's partial though.
Yes. And then the fees that you're charged, the fees that you're charged will depend on the tier that you're using. So for this account, we are looking at a tier 1 account. That is the amount of fees that you'll be looking at. So that's what all is that. The interest is specific to your VIP status. So you can look at the fees and how Binance ranks the users. You get to, if you trade more, you get better discounts. That is fee discounts and all that. And as usual, you can always use BNB to pay this. You can set up your account to pay with BNB, which you get cheaper rates as well, 25% cheaper. So in the repay, oh, sorry, there was also the repay option. Or you can, yes. So you see, you get the option to repay. Sorry, that is dropping. Let's look at repay here. It's the same thing. You can either do it there or you can do it with a trade. So you can trade to repay. This is a trade to repay. You see, so you can either do a borrow trade or trade to repay. So when this position closes, the amount that is recovered is used to immediately repay the loan. Otherwise, you get to be charged the interest while you're not using. That's the difference. That's the main difference here. With the futures, you are not, when you close a position, you don't continue to get charged because everything is automatically returned. But here, in the margin trading, the amount that you have borrowed remains in your account, so you get to continue holding without even trading it. You continue holding it, so your position will get to, you can sell it and get the profit without having to repay the loan that you are taking. So you get more, your profit is not used to repay. Unless you have set it to automatically repay. So I believe that is all for the margin part. Next, I think we can look at the leverage tokens as part of
Right. Right. I think we can look at the leverage tokens, and I think the session has actually run for so long today. But we intend to keep you, rather to give you more of this particular knowledge, and in case you are able to stick to the end of the session, that will be very great, so that you are able to learn all these particular products. Just before we go to the leveraged tokens, um, may we please answer this question: how is the result being calculated? If my trades goes to 130% plus with a capital of 200 USDT, how much is my profit? Victor, are you able to answer this?
Repeat the question again.
How is the result being calculated if my trades go to 130%, if my capital is at 200 USDT? How much is my profit?
Uh, we would need more details on this one, but I would assume that this is because you're not told which kind of position he's taking, whether a short or a long position. I'll not be sure. I'm not able to answer that one.
All right, all right. Something else, maybe if it was on spot or on margin, and you were not, if you were in, say, 5x margin, you'd have to almost multiply the percentage onwards. But whenever you see something like 100% gain, if you had your entry point was at, let's say, X amount, and then your $200 would have been 2x of that if it was 100%. But if it's 130%, just do 2 point, your initial capital, which could be represented by 1, and then the actual gain, which is 1.3, which is 2.3 times your $200. That's how you would calculate that. So it's not $260. I see Israel saying it's 260. No, it's 2.3 times your initial capital. That would be, I believe, 100% would have already doubled. So about, just a second. So that would be 2.3 by 200. That's $460. That would be your total capital, and now your profit would be 260. Yes, sorry, Ahmed was actually right, says the profit is 260. Yeah, that's correct. So please proceed. Please proceed, Victor.
Okay, so these are the leverage tokens. So they are managed. Binance kind of manages these ones. Has is more like you're getting the power of a fund manager, but the risk is whatever you're getting is the ability to control your position. So it's more like they call it an EFT, an exchange traded ETF, that is an exchange traded fund. So what you do, these coins come with a leverage attached to it. So you might get it between 3 to 5, or is it? Yes, you get it comes with leverage attached to it, and you mostly find the leverage indicated here. Well, it's up to 4x between, you can see from 1.25 to 4x. So at any time you get in, you'll get to see the kind of leverage that is being used. And then you also get a management fee. When you hover over the contract on the desktop mode, you get to see the daily management fee. As I've said, because there's somebody who's doing the dirty work for you, that is why you get to have a management fee. So what this one does is you're trading on the net asset value of the of the of the fund. That is, so you get to have a share of the fund's value, total value. So you can see the total basket. These are the numbers of, here's the amount that is inside there. You get to see what you're trading on. You're told that the basket includes 609.865 BTC USDT futures contracts. That is what you're trading here. That is a BTC app. It's a better way of trading things like the futures through leverage tokens. So that's how you get to do it. And then when the price, the good thing about this one is that there's no risk of liquidation. The only risk that you're facing is a rebasing. So there are those people who do not like, who as humans are told, there's a behavioral finance part of it. They say that there are people who do not like, who are quick to take profits. So they will be taking a profit of, let's say, 1%, but they'll be willing to hold a loss of up to 100%. You see, so those are the kind of people who will be affected by a rebasing. So you're not necessarily liquidated, but while you are hoping that this price changes, then you continue holding your asset into, which is a wrong. Once again, that's the wrong way to trade. You need to have your stop losses. You need to understand your positions. You need to be ready to get out when things go against you. So you can see the tokens issued here. So this contract, basically what it says that it's a BTC up contract. When you buy this contract, you're betting on the Bitcoin going up. There's also the BTC down contract, which is on. You can find them. You can actually search for whatever you want to, any contract that you're looking for here. So the BTC down is a contract against Bitcoin. That is that it says that the contract will go, that the underlying asset, which is the BTC, will be dropping in price. So when you buy that one, when you buy that contract, the down contracts, you find many down contracts. You also find the BNB down, ETH down, You see BNB down, Ethereum down, and up. So whenever you buy a down contract, is equivalent to shorting, and whenever you buy an up contract, is equivalent to going long on the position. As you've heard, these are all futures contracts. They are futures. The underlying is a futures contract. You can see here, as indicated here, we are told the basket contains futures contracts. So that is basically what you're getting, and then you get to pay a management fee. And
So
then you can
Victor,
say something extra.
sorry. I see someone asking, like, what's the worst case scenario of holding long term on long term basis? So let me take on this, but I'll start a bit earlier. Just give you a bit of layman's and a very easy way to understand these leverage tokens. So of course they help you get the exposure of leverage to the price of crypto without the risk of liquidation. First of all, remember, in futures and margin, there's actually a risk of liquidation. Those of us asking, what is liquidation? Liquidation is the process where, you've reached a point where, um, you've reached a point where your collateral is too small for the loan being lent to you, and now your assets have to be sold for the platform to recover the amounts which were lent to you. All right, so that is what liquidation is. So leveraged tokens allow you to access allow you to participate in have rather exposure to leverage without the risk of liquidation. So this way, you are actually able to enjoy enhanced gains that leveraged products can give you, while you're not having to worry about the managing of a leveraged position. Those of us who focus right now, you'll realize that one of the major issues with having open positions is the market volatility. And yes, it can be affecting these other particular price. It can be affecting, your position, but this means you don't have to manage the collateral. Rather, you maintain margin requirements, and of course, there's virtually almost no risk of liquidation. All right. So, how do they really work? How do they really work? First of all, um, first of all, you'll notice that they are indicated as BLVTs, Binance Leveraged Tokens, which are, first of all, understand that these are tradable on the Binance spot market. We've covered what's the difference between the spot market and the margin account and futures account. We've covered that difference. So each leverage token, allow me to call them BLVT because that's how we are used to call them. Each of them represents a basket of like open positions on perpetual futures market. So basically, BLVT is essentially a tokenized version of the leveraged futures positions. All right. So when you see, let's say, a BTC up position, it basically means this. It's a position basically to long the market. If you see a BTC down, you're basically saying, okay, Bitcoin will go down, so I'm shorting the market using the leverage token. So now the leveraged gains an amount of between 1.2x 25x to about 4x. That's the how much it's leveraged. All right, so if you're, by any chance, it trades between 1.25x leveraged to 4x leveraged. Now, how do they really work? So one of the major differences between BLVTs and other types of leverage tokens is BLVTs don't try to maintain any constant leverage. Instead, they try to aim for a target range of a variable amount. So in case, let's say it's BTC down or BTC up, the range can be between 1.25x to 4x, which acts as a perpetual leverage target for these particular tokens. All right. So the idea is to kind of maximize the potential gains whenever the price goes up and minimize the risk of liquidation whenever the price goes down. So, Victor, I'd like us to look at the spot price of Bitcoin. If you're looking at this particular leverage token, in this case, it's gained at 4.6%. That is BTC up. But if you look at BTC itself should have gained anywhere between 1 point something to 2.5, 2.6 there, because these tokens are leveraged. So they, in case, yeah, I see it's 2.43. So in case Bitcoin moves in any of the direction, then the movement of the leverage token will be between 1.25 to 4x of what the underlying asset, which is a futures contract of BTC up, is. Now, let me not complicate this. Think of BTC up as a spot, as a as an asset you can buy on spot, except that it has leverage which is not constant and and of course it's not publicly visible, but then it's kind of dynamic. It adjusts based on the market condition. All right. So the main reason why this is not public, it's because it helps prevent what we call front running. So if these tokens are rebalancing at predefined intervals, there could be always other traders trying to take the advantage. That's why Binance leverage tokens try and keep this information not public, so that other people are not exposed to such risks. So now, of course, they are traded on the spot market. And why would you use the leverage tokens? So one of the main sources of confusion around the leverage tokens is the concept of volatility drag. So in simple terms, what volatility drag is the detrimental effect that volatility has over your investment over time. All right. The greater the volatility and the larger the time horizon, the more significant effect of volatility drag is to your performance of the leveraged tokens. So the longer you hold in them, there is a higher chance of these positions getting into being rebalanced. Rebalancing basically is what Victor said as rebasing. Rebasing is where, since it's a futures contract, now I'm now answering the question of what's the worst case scenario of holding BLVTs long term. So I'll tell you a scenario where, let's say, a rebalancing has happened and you had 50,000 BTC up tokens. Now the rebalancing has happened and you're given the ratio of the new pool, which could be lesser coins, which is like 46,000 tokens, but with the same value at the current particular time that you're holding it. All right. Now, if there's extreme cases of volatility and this happens multiple times, then you may have had bought 50,000 of these tokens, but then you find your wallet having 30 something thousand. That's what we call rebalancing. Because of course they are leveraged, so they need to kind of rebalance. All right. So something we should look at is what are the fees involved in Binance leverage tokens. So whenever you're trading BLVTs, you'll need to keep in mind of the fees that you're going to pay. This is another thing that I'd like to respond to Joseph about. So you'll need to pay the trading fees, since BLVTs are traded on spot, just like any other coins, that is, any other cryptocurrencies. The same fees apply, which is 0.1%. Of course, if you're using BNB to pay the fees, it becomes 0.075%. Now, you also need to pay a management fee. So bear in mind, these tokens represent open futures positions in the market. So you'll be essentially buying a tokenized version of these particular positions when you are buying a leveraged token. All right. So to keep these particular positions in open, you'll need to pay a management fee of 0.01% per day. So this translates to an annualized rate of about 3.5%. So if you're not careful, this could actually affect you. So in addition, there are other ways, to exit your positions in case you're holding BLVTs. One of the way, of course, is to sell on the spot market, which is very easy. However, you also have a choice to redeem them for the value they represent. So when you redeem these BLVTs through the second process, you'll get a value of your tokens paid in USDT, all right? So in this case, you'd have to pay a redemption fee of 0.1% on the value of your tokens. So that's the main difference. That's the fee structure you're looking at. So of course, it's not, rather it's worth it noting that during normal market conditions, you'd better off, exit on the spot market as you're just paying the normal trading fees. So that's the main difference. And of course, you need to learn more. So I'll share. Rachel, please, you can share one of the information pieces that we have on the Binance Academy, and then we can be able to kind of also get to understand more about that. Now, I believe we have covered most of the leverage derivatives. I think we have not covered the battle product, which will be covering it at a future time. Victor, please highlight the derivatives products. Victor, please highlight the derivatives products. And yeah, so I believe we've covered futures, we've covered basically both types of futures, options, and leverage tokens. Now, one thing we've not covered is the battle, which we'll cover at a later time. But the one thing I'd like us to cover is responsible trading behavior. And I'd like Victor to talk us through how can you really trade responsibly.
So the basics of responsible trading is you understanding your risk management as well as your capital, because money is not free. You don't necessarily get money free, and then you also need discipline. You need to be disciplined in that if you're making losses continuously, then your strategy is no longer working. So you need maybe to take time off. You do not get yourself into excessive debt. That is amounts that you can no longer handle, because you'll find that there are people who trade trading the same way as they treat gambling. So that's where trading becomes gambling. When trading becomes gambling, then you've lost your sense of discipline. You're no longer protecting your capital. You're no longer protecting yourself. You're no longer doing educated trades. What you're doing is digging yourself into a bigger hole. You'll find that such people will most likely have uncontrolled debt. So it's more like an ad. So what we're looking at is you are told that you need to use the features that are available on Binance to control the ads, because everybody is addicted to something. If I make a loss today, then I need to be very sure that tomorrow I can manage the position that I have. So not that if I make a loss today, I make a loss tomorrow, my capital is going down, then what I need to do is add more loans on it so that I can trade. You need to be careful. You need to watch out, because anything loss making, as I said, there are people who take profits quite fast before they even materialized into anything useful, but they hold their losses up to 100% loss. So such behaviors are what needs to be avoided. So there's an anti-addiction notice. You can see these are the features that Binance has, because these, while trading derivatives can be quite pleasant, it gives you the option of trading with leverage, which increases the chances that you lose all your money. So you need to be quite careful. So you'll find out there's a cooling off period function that you can activate on Binance. Gives you a time period where you'll be locked out from trading. You also get a price protection feature, which is more of a risk control measure. You'll find it actually when you're trading, you'll find that option to price protect. You also have insurance funds, and there's also the where you look at things like auto deleverage liquidation indicator, the ADL. You see, you also get to have yourself there protected. That is, your other positions are protected. That is in the futures and the margin where you've found yourself in total loss. So you get to, if you click on the ADL indicator, you get to see your position on the list for protection by the insurance, because at times it might be overwhelming to the system such that the insurance fund is not able to cover everybody's positions. So you're protected against the losses because your account has gone to zero. So, and you also get to find content about it. You even get Binance will even give you quizzes before you can see. You remember when I was clicking on some of the features, we are getting the quizzes so that you can get to know whether you understand what you're getting into. So Binance is about responsible trading, and it's not about gambling. That's the difference between gambling and trading. The difference between gambling and trading is discipline, and that is what we are looking for. We are looking to trade. That is why you have these lessons here, so that you can know how to trade responsibly. Manage your risk. Use the risk management tools that are there. You've heard about OCOs. You've heard about limit orders. Those are what you're looking for. Those are what you should be using. And then you've heard about controlling your capital. Don't risk at any given point. Do not risk more than 1% of your capital. And if in a week, say you've lost 1% of your capital, then you need to find ways of gaining that capital, whatever, before you get back into the trading. That is both responsible trading. That way you get to trade better, you get to focus better, you get to be wise. You will not be doing what we call trading on impulse. That is, you wake up, you have not done any research on the position, you're just entering. Hey, the price is going up. You've gone to social media, you've seen people shouting the price is going up. Then you've gone and bought futures at 100x. The next thing you know, you are liquidated. You see things that do not make sense. So you need to trade responsibly. Come to the classes. We will always have classes for you as a Binance East Africa community. We always have classes for you so that you can better manage your positions, better trade, and learn more skills of trading. So with that, Monene, you have something to add?
So all I'd like to say is, in terms of responsibility. Oh, first of all, yes, Binance is protecting you a lot. I've just seen these insurance funds. Some of these platforms will, I know people don't know this, but in some extreme cases, whenever there is like flash crashes, you'll find that platforms like Binance are able to kind of protect you in case your positions go below the liquidation points and you're left with a negative balance on your account. That's a possibility. However, that cannot happen on Binance. Why? It's because they are kind of insuring you as well, so that in case of such a case, the insurance fund is what pays for that. All right, so you'll never have a negative balance on your Binance account, simply for this particular reason. So of course, Binance also gives you a lot of support in terms of teaching you a lot of these things that we are covering. We've previously covered technical analysis. We've previously covered spot trading in depth, and these are some of the things you could be using whenever you're trading on futures and on these derivative products. You're just not buying without understanding. And we also show you how to do research. We give you clearly steps on how to do research. And one of the things that I know affects the market so drastically is the news that may affect the market. And previously we've covered macroeconomics that affect the markets. So this is one of the things that we really would like That's one of the reasons that we'd like you to join the Telegram group, so that you are able to follow these. Maybe someone is announcing, the interest rate hikes. Fed is announcing that. What are the expected outputs? What are the expected, um, you know, um, effects on these particular markets? So these are the things that not everyone will tell you, and these are the things we are trying to kind of help you with. So I see Mercedes Ronald says, common saying for profitable trader is care about your capital, MOE, than your profits. All right, care about your capital than your profits. Geez, that's a good saying there. I'll show this here. MOE, I think, sorry, Masati Roland, I like this, and of course you're eligible now for the giveaway. DM me Madendu_KE for your for your Binance gift card that is worth not less than $10. So now, Victor, I believe we've come to the end of the session. I see I have how many more giveaways to run? I see I have 1, 2, 3, 4, 5. I have 5 more giveaways to run. I will make one of these random, so that everyone has an equal chance to win. One of it will, actually 2 of them will be random, so that everyone has an equal chance to win. So how will we run this? Remember, I said let's join on the Binance East Africa Telegram group. All right. We said let's join the Binance East Africa Telegram group. So what I'll do is I will pin 2 gift codes on the Binance East Africa Telegram group. So I'll give you all a chance to join the group. I'll give you all a chance to join the group. All right. Everyone gets a chance. Let's get these, and everyone gets a chance. All right. Now, I'll put these 2 codes on the Binance East Africa Telegram group. And to make it fair, so that you guys are the only ones who can win, I have added the word YT at the end of each code. I've added the word YT at the end of each code, so that no one else other than the people in this group can be able, in this masterclass, can be able to redeem. So get the codes, remove the last 2 characters, that is YT, and now go redeem it. Of course, first come, first serve. The codes can only be redeemed one at a time. So the codes can only be redeemed one at a time. So we still are not out of codes. We still are not out of codes for our Facebook viewers. All right. First of all, let's all go on the Binance East Africa Facebook group. Let's all go to the Binance East Africa Facebook group. I'm sharing the link right here. We also, this webinar is actually there live. The Binance East Africa Facebook group, it's right here. I've pasted in the link. Click on that link. Now, I will post 2 gift codes. 2 gift codes right there. And the first ones to redeem will be the lucky winners. I'll post 2 gift codes, and the first ones to redeem will be the lucky winners. And now, to make this even more, more. First of all, follow the Facebook page. Otherwise, you won't be able to see the post. Follow the Binance East Africa Facebook page. Otherwise, you won't be able to see the post. Guys, I'll give you time. Follow the Binance East Africa Facebook page. I've pasted in the link right there, so that you're able to see the post. Follow. I believe we should give 30 seconds. 30 seconds, and just a second. Please follow the group, otherwise you won't be able to see the post. All right. Now, and I'm posting them right there, and we are good to go. Just a second. We are about to post the Facebook pictures, the Facebook codes, and You will be able to see them. You will be able, and in 3, 2, I'm posting right away. Find the yellow post that just showed up and redeem the codes. Find the yellow post that just showed up and redeem the codes. And the remaining code goes to Masete Ronald. DM me that is Mathendo underscore KE. DM me, that is Mathendo underscore KE on Telegram. That said, it's been a great session. I would like to invite you for the next one. Of course, we have our Tuesday newbie walkthroughs, which happen every Tuesday. And we also have the Sunday Shield, which happen every Sunday at 8 p.m. on the Binance East Africa Telegram group. So don't miss out. We have these rewards as well. So in that said, Rachel, let me know, what do you think of the session? Tell us your views, and talk to us, and give us a closing remark from yourselves.
Victor, for today's session. It's been very educative, and personally, I've learned a lot. And I hope our viewers have learned. And in case of any questions, we'll be in answering any more questions that you'll have in our Telegram channel. So my last remarks would be just a reminder, just a conclusion, and to emphasize that trading any market is risky, especially when using margin products. So it's extremely important to implement a solid trading risk management strategy. So you need to manage your risks, and remember to use the stop losses and limit orders. And for futures trading, Binance has an option on the Binance app. It has a cooling off period. So in case you're losing a lot, you can always cool off, have a period to cool off, and practice your trading with spot trading. And you can always come back and turn off the cooling period. And also, just like Victor said, stick to the 1% rule. So don't trade more than 1% um, of your assets. Yeah, so those are my last remarks, Mathendu. Mathendu, I can't hear you.
Oh, so sorry, I was muted. Thank you so
Yeah.
much, Rachel. So, Victor, do you have any last remarks that you'd like to tell the viewers?
What I can say is that there is money in derivatives. There's good money. All you need to do is have a strategy, a trading strategy, and this cannot be emphasized enough. So you need to have a trading strategy. You need to have to know before you get into a position, you need to know why you're getting to that position, where you get out where you get out, and most importantly, the amount of risk, the amount of capital you're willing to risk for the expected gains. You need to understand that. You need to know that you're entering into a position, and the position, because you're not able to predict the market. We do not predict the market. We just analyze the market and decide and take us and take a what do and take a stand on where we think that the market will head. We do not get to predict it. We just take a gamble. It's not gambling, but we just take. Yes, we decide that, hey, this one might be going up. We just join the people who are trading. We join the momentum. That the momentum is going up, then we trade up. The momentum is going down, we trade down. There is some bad news coming. I think that will affect the market negatively. So I trade a short position. The news is coming out that will affect the market positively. I take a long position. So you need to know why you're getting to that position, where you get out, and how much you're willing to risk to get into that position. So with that said, trade responsibly, use all the features available to make a living out of this, because you can actually make a living out of it. So all the best. Thanks.
Thank you so much, Victor. Thank you for that. It's been real, guys. Let's meet on Telegram. Ronald Masete, find me on my DM. That is by Matendo_K, so that I can be able to reward you. Thank you, everybody who made it to the end of the session, and have a